Hello everyone, welcome back to the Best SPAQs August 2020. So a lot of you in the comments have asked me what are my favorites right now, what am I investing in? So today we've got some growth stocks, we've got some established companies, we've got some spec plays that have high potential, but also some risks, and I'm going to give you some bonus. But I know everyone wants to know, I'm sure you guys have been wondering, is Hyliion Patrick's number one? So we'll talk about that right now. All right. So, Best Packs August 2020. At rank number 3, we've got, drumroll please. Yes, we've got the Tattooed Chef FMCI, which is my number 3 for a few reasons I'm going to be talking about. But yes, that's me in front of the frozen food section at Sam's Club, looking like an idiot taking a picture of myself holding cauliflower mac and cheese from Tattooed Chef. What did I think of the product? Well, I mean, I'm not the biggest vegan, right? I also like other types of food, but it's good for what it is. I mean, it's a replacement for people that are into that sector of food. And these bad boys aren't cheap. $10.98 for 2 packs, or not 2 packs, but 2 trays, right? So they aren't cheap. So you can all thank me for contributing to the earnings of Tattooed Chef next quarter. And here's why I actually like this stock. So Tattooed Chef, ticker symbol FMCI, is one of the companies that I really like right now. I feel it's under the radar and it's a little underappreciated. So if you look at the stock price, it's at 15.66 as of me filming this. It hasn't dropped nearly as much as some of the other stocks. And the reason is very easy. It's an established company that's already has products in the market, so you kind of know what you're getting with this company and where they're going. So the price hasn't dropped nearly as much as some of the other more speculative stocks that you don't really know what they'll do in the future, right? You only have to anticipate, and because of that, they're more risky. Well, with Tattooed Chef, it's very different. We know what they're doing. They're a plant-based food company that does frozen food, and that they sell them in big box stores like Costco and Sam's Club, and also in supermarkets. So they have the cauliflower cheese pizza, they have the mac and cheese bowls, zucchini spirals. They have all sorts of these frozen food products. So, two of the reasons I really like this company are that they are in a growing sector and they have growing revenues. If you think about plant based foods as a category, well, it's a category that's growing. There's more money flowing into this sector than there was before, and you can expect that there's going to be more in the future. People now want to eat cleaner and be more healthy than they did before, and we can anticipate in the next few years it's a trend that's going to continue. It's more of a lifestyle now. Eating clean, exercising, going to the gym. I even started running now. So I'm part of that lifestyle, and I can tell you, people are really into that stuff. They want to eat clean, they want to avoid the junk food. So it's a very growing trend. Not a fad, a trend. But also, they have growing sales. If you look at their sales, 2018, 47.9, 2019, 84.9, and those aren't projections, right? In other SPACs, often we only have projections. These are real sales that the company has. So in 2020, you can expect 148, and in 2021, 222 million. So they have pretty nice growth in a growing category. So the company has a lot of tailwind, like that's going to push it forward. There's a fundamental shift in people's attitudes that really is going to help the company grow. And something else that's very good is they recently announced their results for the first 6 months of the year. They announced their preliminary revenue. So up until June 30th of 2020, their revenues increased 97% year over year to a 65.2 million, which for them is a record. Now think about that. That confirms the projections that they announced in their investor presentation. So they're on track to meet the numbers that they projected, which is very good for us. 97% increase in revenues, it's almost triple digit. So now we're dealing with a growth company. We're not dealing with a company that's just going to give you 3% dividends for the next few years, right? This is a company that you can expect is going to keep growing at a fast clip. So we already know that they have good growth, but they have other growth opportunities. Right now, they're in Costco, they're in Sam's Club, and some supermarkets, but they're actually missing several big partners and supermarket chains. Like, you have thousands of stores right now that they're not in. So as they grow their revenues in each store and add new ones, it's just going to compound onto each other. So it wouldn't be a good review if I didn't tell you some of the risks. Well, the risks are fairly limited with this company because it's a food company and everyone has to eat in a growing sector. But they could face competition. What Tattooed Chef does really well is that they're actually private label for some of the big box stores. So you'll have on one shelf Tattooed Chef and then you'll have the store brand, but they're both from the same company. They're both made by Tattooed Chef. So they're kind of competing against each other, right? They might not get the same profit margin on both, but that eliminates some of the competition, which is very good for us. And then another one of the weakness of being a food company is that the multipliers are a lot lower than some other industries. If you think of a EV SPAC, the multipliers are massive. You can lose millions of dollars and still have a valuation in the billions, right? Because people, the investors, are looking at what's the maximum potential that this EV company can get. If you think about Tesla, they don't make that much profit, but the company is worth 275 billion or something crazy. Well, it's not going to happen with Tattooed Chef. The multipliers for food companies are much lower. So if you look at these established brands, it's very low. Now, what goes in our favor with Tattooed Chef is that they're in the alternative brand of plant-based food. So now you're dealing more with Beyond Meat type companies. So I don't necessarily think it's going to be a value like Beyond Meat, but we can expect a premium over traditional, very low growth stocks. So what's my verdict on FMCI Tattooed Chef, and how am I playing it? Well, I'm long on the stock, and I also sold puts at $20, so I expect that it's going to go higher than that. But I don't expect a massive spike and then the roller coaster. I expect that it's going to be a steady increase over time, as it's a growth stock, and people are going to notice, hey, every time they report their earnings, this company is growing really quickly, and there's no end in sight to the growth, because it's a massive market, and they literally just started into it. So they'll also improve their margin over time. So I really like this stock. It's going to be one of my long-term buy and hold. It's not the type of stock that I'm going to be trying to trade like repeatedly, right? I think that it's going to have a long, steady growth, and that's how I'm going to be playing this one. The number 2 SPAC on my list for this month is LCA, Golden Nugget Online. You guys know I love this stock, and we can see that it's trending up right now. It's been in that channel from $12 to $14. Now people are anticipating that we're getting closer to the merger, so it's on its way up, and I'm going to be buying more shares. There's a lot to like about this stock. If you guys have a moral like you don't like gambling, then you can avoid it. But for me, I don't mind gambling, and I think that this stock is going to be a long-term moneymaker for sure. If we look at their revenues are amazing. The growth is amazing. Right now, they're only in one state, New Jersey. And if we look at their revenues over time, it's been a steady growth, very, very nice growth, right? In just one state. But what's really interesting is that they've really benefited from the current Rona situation. Whereas more people stayed home, the revenues of the physical casinos went down significantly, but their revenues exploded. So every month the Gaming Commission reports the numbers because they collect taxes. So we know what revenues the company has right now. Well, if we look at Golden Nugget, the physical casino is not doing well. They're losing 54.6% of their revenues over last year. But their iGaming, which is what we're going to be getting in this SPAC, is up 111.3% year over year. Are you kidding me? 31.4 million versus 14.8? That's more than double what they made last year. They're profiting from the Rona, as opposed to a lot of the other companies. So if you look at their projections that was in their investor presentation, the revenues that they're getting now are higher than their projections. So you can expect that in their investor presentation, right, they're trying to sell this to investors. They're going to be very optimistic. Well, the reality is they're actually making more revenues than they anticipated and they were trying to sell you. To me, that's extremely bullish. It's one of the reasons why I have that company as one of my top 3. So one of the main risks that casinos typically face is that they're in a heavily regulated industry. And right now in the United States, there's only a handful of states that even allow online gaming. So they started out in New Jersey, that's where they got their license, but in the next year they're going to be expanding to Pennsylvania and Michigan. Just by doing so, the market size in 2025 is going to go from a potential 950 million to 2.5 billion. So just right then and there, by opening those those 2 extra states, it gives them a potential of 2.5xing their revenues and their profits. But that's not all. That by itself is okay, but it's not great. What we really want is we want the biggest markets in the United States, which would be California, Texas, New York. That's when the real money would really come in. Well, what do we know? We know that it's probably going to have the same type of structural tailwind as FMCI does. Right now, we know that states are going bankrupt. Before the pandemic, they were struggling. A lot of them were running out of money. But with the pandemic, they just are going bankrupt. So they absolutely need taxes. In my state of Virginia, they didn't want casinos for the longest time. And now they're talking about opening one in Richmond. Well, we can expect that this trend is going to continue in other states. States that didn't want them before are going to start allowing it because they just need those taxes. Well, that's going to be very good for Golden Nugget because since they already have the infrastructure in place, they'll be able to open up all of these different markets. And as they do that, that's just their potential market size that increases exponentially. So the last slide I want to show you guys is the return on investment. This is why I call it a money printing machine. So if you think of their physical casino in Atlantic City, which is they can keep it, I don't want it, right? Their return on investment is 15% because to build it, they incur a lot of debt. And then you have to spend a lot of money on employees just to keep the lights on. Well, it's very different with the online gaming platform. That's the only thing I care about. Once you have the software, you have some engineers to maintain it, and you have customer service people, the only one expense that you have mainly is advertising to acquire new players, right? So once they open new markets, all they do is they don't build a new casino and spend 2 billions. All they do is allow new players to sign up in those states, and then they maybe recruit some members on their team for the more volume of customer service that they're going to be needing, right? But the expenses are going to be much smaller and the profit margin is much, much, much higher. So look, right? They say 15% for their returns on the Atlantic City Casino, and GNOG is 288%. And we can expect that this is going to stay very high because as long as they spend money on advertising, that's their main expense, they're going to acquire more players, and it's a very high profit margin. So what do I think is going to happen with LCA? Well, I think that at the merger, there's going to be a little spike to it because people are going to be more excited about an online gaming company than they would be about a food company. So I expect that it's going to go up, and my strategy has been to buy more shares than I intend on keeping because what I'll do is I'll sell some shares, lock in profits, and then I'll be playing with the house money, which is the best way to go around about it, right? So long term, what I think is going to happen is you should guys, especially if you're more of a passive investor in dividends, look up my video where I review this stock. I talk about how in Europe they give out usually about a 6% dividend. So if you guys are more into fixed income type stocks, this might eventually end up being a company that will fit your criteria once we reach maturity. Like once they've expanded to a lot of states and they have a lot of revenues and profits, I think that they're going to start giving out a dividend. So that might be interesting for you guys. And at number 1, we've got the Hyliion, ticker symbol SHLL. Some of you guys probably guessed it already. And hey, some of you guys really didn't like when in my last video I mentioned that my price target is in the 40s. And it really rubbed you the wrong way when I was comparing it with Nikola's. But remember, I wasn't talking about the product. I was really talking about the valuation. Because Nikola's valuation in the almost $20 billion is very high for a company of this size. So when I'm talking about Hyliion, I'm very bullish. I just want you to be cautious about the price, right? Right now, we can see in the chart, it went from 20s to it went past 27 today. So it totally crushed 2 of the support over the past few days. So I do expect that it's going to keep going up, right? I expect that at the merger, there's going to be a nice spike. But at the same time, I want you to stay cautious, right? And remember that there's been more of an upside priced in than some of the other SPACs I talk about. So what do I like about this company? Well, the fact that they're actually making a technology platform for Class 8 tractor trailers is a benefit. It does limit the potential a little bit, but at the same time, it makes it so the odds of success are a lot higher than some of the other companies like Nikola that are starting from scratch. Because in this case, what they're doing is they're licensing or selling their products to other manufacturers that are already making trucks. So the barrier to entry is a lot lower. It's a lot easier than starting from scratch, building a technology, building a facility, right? In this case, they already have the technology, they have some products on the road. Now they just need to sell it to the third parties. So here we got Freightliner, Peterbilt, Kenworth, Penske, Ryder. All companies are already making trucks. Now they can use this technology and convert some of their trucks to electric vehicles. So if that's the way of the future, because we know a lot of states are mandating that trucks become electric vehicles, right? There's already 15 that signed the pact, and we can expect that there's going to be a lot more eventually, especially if Democrats get elected. Well, that's going to be another tailwind. As I keep talking in the other SPACs, it's a tailwind that's going to help the stock grow quicker because there's going to be a structural push towards electric vehicles and they're going to be at the forefront of it. There's not that much competition. So the fact that they're doing this for companies that are already existing, they already have the technology, eliminates a lot of the risks, which is good. One more thing I like about the company is the leadership. Thomas E. Lee, the CEO, thinks about the various possibilities and made it so the company is very versatile. So in the investor presentation, they talk about their product being fuel agnostic solution. Why do they say this? Well, imagine that they went all in on renewable natural gas, which is a current fuel that's number one, right? But imagine that that solution ended up not winning the race. Imagine that hydrogen fuel cells actually the technology develops faster and becomes the number one solution. Well, if they had gone all in on one solution and it was a wrong one, the company would be in deep trouble. But because they're versatile, they're going to be working on both solutions. So as the hydrogen fuel cells become more prominent as a technology, they'll be adapting their product to use that too. So they'll have both options. Regardless what company wants to do, they'll have an option for both. So that way they're not painting themselves in a corner where if they're right, they'll make tons of money, but if they're wrong, they're going to cripple the company. By staying agile and flexible, no matter where the market goes, they'll be able to adapt and profit from it with their partners in the trucking industry. That's very smart from the CEO, and that's the way I like. I like the fact that they started with a transitional product, just converting them to hybrids. Now they'll be converting them to electric vehicles using natural gas, and if it becomes hydrogen number one, then they can switch their product to that, right? So they're very flexible, and that's one of the main strengths of this company compared to some of the manufacturers. So before I wrap up and mention what my strategy is for Hyliion, I just have to briefly go over the financial projections. Now, just remember, guys, I know some of you are very excited right now. There's massive FOMO, but just remember, the first 2 years, it's going to be very mediocre. They're not going to be making any money, right? They're not, according to their own financial projections, they're not going to break even until 2022. So I know some of you are excited about the short-term profits and you'll be able to sell the stock at a profit after the merger. But for those of you that are holding long-term, just remember, yes, we all expect that it's going to keep growing, but it's going to take a while for them to ramp up, right? According to their projections, it's going to take until 2024 until they make $2 billion in revenues, and then that would give them about $700 million in profits. So it's a big market, 94 billion, but it's going to take a while for them to really ramp up. So be excited about the stock, but don't fall too much for the FOMO. It's going to be a rough ride for a while. Now, how am I going to be playing this stock? Well, of course, you guys know I already have a position in it, and I'm willing to ride the wave up. But eventually, if it goes up too much, right, I don't believe that it's an $18 billion company right now. Like, it's going to take 3 years for them to start making significant money. So if it ramps up too much, the price goes to $90 or $80 or something like that, I'm going to be selling my shares and then I'll buy back once it goes down. Because trust me, within the next 2 years, there's going to be some periods where the stock goes down below that price. So that is my goal right now is I'm hoping that it's going to keep surging. If you guys want to FOMO all the way to $80, $100, perfect, do it. I mean, I'll be able to sell you my shares, right? But that's my strategy. I'll ride the wave up. Once the momentum dies down, I'll be exiting the stock and buying back when it comes down. All right, friends. So before I let you go, I figured I'd throw in a little bonus for the month of August. Let's talk about OPES BurgerFi. Don't want to make a full segment on it because it's not one of my favorites, but I do think that there's money to be made if you buy it right. So as you guys know, I bought warrants when it dipped below the support, so I got warrants for 140, and of course right now they're up tremendously, so that's really cool. But there is still more upside if you guys time it properly, I believe. So I think that after the merger, there's going to be a nice little spike because the company has a lot of fans. So when people know about it a little bit more, some money is going to flow towards the stock. So I would be very cautious, of course. I would set a fairly tight stop loss to it because the goal is for you to maximize your gains and minimize your losses. I'm wrong a lot of the times. When I'm wrong, the goal is to minimize my losses, and when I'm right, maximize the gains. So if you set a tight stop loss, then you can't lose too much if you're wrong. But I do think that after the merger is going to get a nice little boost, so that's a potential short-term play for you guys. And the stock is supposed to merge in September like some of the other SPACs, so we should see a nice little run up until then.